What do you see as the key differences between European and African commodity finance markets, and how will your team adapt its approach to account for these differences?
First off, I'd say there's perceived risk on Africa versus the actual risk.
My name is Charles Osborne, and I'm a director here at Trade Finance Global.
Christine Dirringer, Global Head of Trade and Commodity Finance at Rabo.
Welcome to Trade Finance Talks, your go-to trade, treasury, and payments podcast, brought to you by Trade Finance Global. Welcome to Trade Finance Talks. Today, we will be discussing sustainable finance and accelerating into the energy transition. I'm delighted to be joined by Christine Dirringer, Global Head of Trade and Commodity Finance at Rabobank. Welcome, Christine. Thank you very much for joining.
Thank you so much, Charles.
If we could just perhaps start with your role at Rabobank.
So again, Christine Dirringer, Global Head of Trade and Commodity Finance at Rabo. I lead a team whose mandate is to finance the needs of physical commodity trading companies around the world. I've been at Rabobank in this role for 3 years now, but have about 20 plus years of experience in the commodity space. And I hate to say it, almost 30 years in finance overall. My background is I'm French originally, but as you can tell by my accent, extremely Americanized, now a longtime New Yorker. And yes, Rabobank kindly allows me to perform my global role out of New York rather than the Netherlands.
Great. Thank you very much for that introduction. So just getting straight into the questions here. I've previously dealt with Rabobank quite a lot over the last 15 years that I've been in the industry. And I guess we've always kind of known Rabobank's traditional strengths within agricultural financing. But naturally, with a couple of years within renewables, I've also seen the extensive work within the energy transition that Rabobank's been involved in. So Christine, how do you envision balancing Rabobank's traditional strengths with the growing opportunities in energy transition financing?
First, I'll say this is a bank that was financed or founded to serve the needs of farmers, so that's not changing anytime soon, and we do intend to remain the largest food and agri bank in the world. However, energy transition, we've been participating, as you mentioned, for a number of years. We've been financing renewable energy, the bank overall, that is, for over 20 years. We've also, a little closer to home for me, the bank has been financing energy and metals traders who actively contribute to the energy transition for a number of years as well. There have been, let's say, the seeds of an energy transition strategy present in the bank for a very long time, if it's only maybe been fairly recently brought together in a really an articulated energy transition focus. But today, the bank in its wholesale iteration, so its commercial and investment bank, really does have a dual focus of being, like I said, the number one food and agri bank and propelling that food transition, also playing an important role in the energy transition. They don't offset each other, they sort of complement each other, and they're both squarely part of the mandate of the bank. And I think the bank is also in a position, it's a cooperative that's well capitalized, so we've got assets to deploy. So not terribly limiting factor there either. So overall, I'd say there's growth potential, and we're poised to grow across the commodity spectrum, I'll say.
Well, fantastic. It's always great to hear in this environment banks and FIs that are encouraging growth across the board. So that's very refreshing to hear. The next one I was going to ask is, are there any specific financial products you might develop to support clients navigating this transition?
Just a reminder that I'm speaking from a commodity finance perspective. And for commodity finance, traders really need, in these developing markets, liquidity management, because these are going to be nascent markets with price fluctuations. We have a number of tools already, and really what we're looking to do is expand those to cover the important energy transition commodities, in particular transition metals. They're already kind of well established with some of the energy products, but I'd say transition metals are becoming more and more important. So when you think about it, it's repos in those metals categories, providing maybe liquidity swaps on those metals. So overall, trying to accompany our clients on that journey and providing the right liquidity management tools. And as a complement, also finding ways to finance CapEx projects that maybe don't fit the traditional project finance mold, because these new energy, or the way that energy is now distributed, will change. You're going to need CapEx. And again, they don't always fit that traditional mold. So we need to get a little creative in terms of CapEx financing. And lastly, I'd say the carbon credit space. We're actively looking at and figuring out how to finance effectively, both regulatory and voluntary.
Thank you, Christine. Yeah, it's some very interesting points. The last one of which on carbon credit is something we're paying a huge amount of attention to, actually. And it's very interesting. I think there is a real need to scale that market and increase investment. So it's great to hear that that's kind of on the horizon. Keeping the content on the critical minerals side, some very interesting points on that. With the energy transition driving increased demand for specific metals and minerals, one of which obviously copper, people talk about that being the lifeblood, essentially, of the energy transition. How do you plan to develop Rabobank's capabilities in metals and mining finance while ensuring adherence to environmental and social governance standards?
And maybe just to remind people, we have a large metals portfolio. It is focused on traders rather than mining itself. What I have really appreciated about Rabo is that doesn't shy away from the dichotomies that, say, those metals portfolios bring up, right? The mining sector is ripe with ESG issues. I think what the bank does well is has a robust discussion and really does deep due diligence on where those metals and minerals are sourced and how. And are we comfortable with it, recognizing that it is not perfect? These mines have room to improve. However, that is where those metals and minerals are sourced. So we need to recognize, are we comfortable with those trade-offs? And we're focused on how do you help those via financing the traders primarily who buy from those mines, or maybe their parent has a mine, but how to encourage the betterment of the ESG situation of those mines. That said, we're often talking about sustainability linked loans. To be fair, there's a lot of fear about greenwashing in SLLs these days. So the tools to do that are a little bit more challenging. So I'd say we do it that way. And then, of course, we have, and we look at this portfolio of clients that are high, quote unquote, high risk sectors from this ESG perspective and look at them every year. We have in-house tooling, and we just make sure that our portfolio is certainly up to standards, and also identify those clients where we need to have, where the client-facing staff really needs to have a discussion about their progress. But we really try and help our clients on that transition and don't just avoid those difficult dichotomies, I'd say.
Yeah, very interesting. Thank you. I think the whole balancing act that you described there, I think is absolutely fascinating. Essentially, these are essential. They're critical. We also have to look in depth at how they're sourced, how they're coming out of the ground. So I think the balancing act is one that's can be tricky, but it's very nuanced as well. And it's very interesting you mentioned about deeper due diligence as well. That's something we've seen coming into the market a lot more. Moving on actually now to a little bit more about reputational risk, which I think is quite interesting when it comes to these kinds of things as well. How would you integrate reputational risk assessment into Rabobank's commodity finance decision-making process? And what role can financial institutions play in educating stakeholders along a supply chain?
We, much like every other bank, has a very robust financial and economic crime, or FEC, department. There's, I think, over 5,000 people dedicated to the function at Rabobank. There's a great deal of attention to all the financial and economic crime risk and how that relates to or can challenge our reputation. We, maybe just to add to that, because there is this dedicated department, but we also, within the business line, really investigate with them any sort of FEC issues that we see arising that could be a challenge for us. And reputational risk, I guess we've touched on it in terms of ESG, but there's also financial and economic crime. And there we have mechanisms to raise those issues to very senior levels of management. And again, I think it's similar in approach to what I mentioned on the ESG topics on the metals sector, where there is an opportunity to have a robust discussion, and it's typically a very open one about particular client or even portfolio effect challenges, and really have a conversation about where does the risk lie for us? How much reputational risk are we taking? And is it worth it because we believe in that client's integrity and approve of how certainly clients have issues, but how are they addressing them and moving forward in terms of their compliance and risk assessment? And we have very robust conversations about that. Individual clients and, like I said, portfolios. I really appreciate that we have that kind of engagement and pragmatic view about what is the greater good here. That's how we try and approach things.
Hey, enjoying the episode? Tap follow for more. Done? Let's get back to it. Given Rabobank's strategic push into emerging markets, particularly in Africa, what do you see as the key differences between European and African commodity finance markets? And how will your team adapt its approach to account for these differences?
Very good question. Couple things to highlight when you're talking about those differences. First off, I'd say there's perceived risk on Africa versus the actual risk. The perceived risk, I think, is higher. It's influenced by the disproportionately negative news we get on Africa. In our experience, we've long had a presence in Africa. Our experience shows that our financing structures are effective, and even when they're tested in court. So I do think the actual risk is less than the perceived risk. A key risk mitigant for us is the form of collateral management agreement that we employ there very often, a lot more often than in Europe. That said, Africa is still different. There are factors that come into play that don't when you're talking about Europe. There's foreign exchange volatility, there's political and economic instability, there's infrastructure and logistics challenges. You're generally sourcing from smaller, less corporate, less formalized producers. So you do have different approaches. So to manage those risks, we rely a lot on structuring, often blended finance solutions, and definitely our local team on the ground. When you're talking about Africa, there's a difference between import and export flows, and that's more important when you're talking about Africa versus Europe. Imports are going to be more exposed to local currency fluctuations. So FX volatility is a critical concern. So we'll partner. We understand our markets very well. We partner with local financial institutions, and we really assess the diversification of the company's operations and its access to foreign currency. Those factors are very important. Exports, on the other hand, are repaid in US dollars typically, or other hard currencies. And that allows us to work with smaller companies or take slightly more risk given the reduced FX exposure we face there. We really focus on those commodities with I'll call it pull in and push out factor. Despite the challenges, again, we've long been in Africa, and we do see significant potential, I'll say, for commodity finance in Africa. And our particular approach is to expand gradually, carefully. We build on our experience. We have a local presence, again, very important. And maybe lastly, strong risk management framework there.
Thank you. That's a lot of information there, so much appreciated. And interesting to hear about the structure you employ in other emerging markets. And I particularly liked your point about boots on the ground, CMA, SMA. I think they're so vitally important. We talk a lot about digitalization. I think that's going to be massively implemented over the next few years. But CMA, I think in certain markets is one thing that just provides that really robust risk management and risk mitigation. Really interesting point. So thank you. Just interesting to kind of go on to more regulatory side now. With Basel IV implementation approaching, obviously that'll take a few years for full implementation. How do you anticipate these regulatory changes will affect trade and commodity finance? And might they accelerate a flight to quality? Or perhaps the better way is saying, might they exacerbate the flight to quality? among clients. How is Rabobank preparing for these changes within its commodity finance division?
I will say this is still TBD, that flight to quality. Each bank is particular. It depends on which approach they take in terms of calculating the risk-weighted assets for regulatory capital purposes. So are they using standardized or advanced? Also, cross-sell is important. And even for the smaller clients, maybe they provide cross-sell to banks that are interested in cash management. Maybe they can make their returns work better. It's a bit bespoke how this is affecting each bank's view of commodity finance. To be fair, especially initially, the Basel IV framework really didn't recognize the value of physical commodities as eligible collateral, and that's a huge problem. That is what led to, or has been leading to, a flight to quality, so to speak. There have been some changes, or as Basel IV begins to be implemented. So, for example, in the EU, through the Capital Requirements Regulation 3, or CRR3, effective beginning of January of this year, that introduces a more nuanced treatment of physical collateral. Still some question marks there, but does include commodities, particularly in the context of leasing and secured lending. I think still a bit TBD. And what are we doing? We are actually maintaining a conversation with the regulators and trying to make sure that our view of how this should be formulated is at least communicated, listened to, we'll see, at least communicated. For now, what we're trying to do is make decisions about what financing we extend using our logic and what we think really is a good deal in this interim period. So there might be some noise around capital, and it may not properly reflect the value of our deals during I'd say, this next year. And the bank has recognized that and said, okay, let's not jump to any conclusions here. Let's continue to evaluate our potential financings through the right lens, or what we think is the right lens, including valuing these physical liquid commodities as collateral. And then we'll work on getting the right capital treatment, and we'll see how that evolves. But it's certainly a risk. I'll leave it at TBD, with different banks viewing it or adjusting to it in different ways. But certainly a risk to, like I think you mentioned earlier, a middle market type complexion.
Yeah.
And trying to find the right financing partners.
I agree. I think it's a bit of a wait and see. It sounds like Rabobank's kind of preemptively speaking to the regulators and, actually communicating, which is, obviously vitally important. But certainly we see our side, the lack of liquidity options for certain SME and mid-sized traders, the growing trade finance gap, and anything that can potentially exacerbate that, certainly something worth looking at. I guess we'll see what happens, right? Let's end with a bit of a nicer one, perhaps. What would you consider to be the 3 most important accelerators of the energy transition to focus on in the next 5 years?
I do think one of the big swing factors is policy and regulation, which can really, as we saw with things like the IRA or the EU emissions trading system, can really accelerate the transition. But they are dependent on the political powers that be and the kind of support they want to give to the transition. But that's definitely an upside. So, for example, the EU emissions trading system can really make emissions trading more liquid and accessible. And in terms of opportunities for the likes of our team, then we could finance more easily energy transition related products like carbon emission certificates. We can also do more green financings of projects initiated by our TCF clients. But I think they do need to understand what the context needs to solidify a little bit and promote that kind of investment. But that can certainly be an upside if you see more of that. The grid modernization and expansion is super important and will change the environment because a significant amount of investment is required in transmission lines because We all know the renewable assets are located in very different areas than where the demand centers are. And there's a tremendous amount of new demand coming online. There's going to be an opportunity for smart grid technologies, AI-driven forecasting. All that is going to be paradigm shifting. And from our own perspective, that means that power traders are important and an opportunity, balancing those renewables, serving to help balance the grid. Also, our metals clients should benefit because there's really a lot of copper, for example, necessary for this kind of build out. And then, of course, natural gas trading required for the balancing of that grid, all of these factors. And then lastly, I'd say battery storage. We know the purpose. It's to buffer the intermediacy of renewables and ensure a stable round-the-clock power supply. But we don't have long duration storage and yet. So I think those solutions will be ever so important. And again, this requires a number of energy transition metals like copper and aluminum and cobalt, and lithium, and that will be an opportunity for us as well.
Well, there you have it. Opportunities within the power trading market in BESS, but policy and regulation and subsidies needs to improve. Just remains for me to say thank you very much, Christine, for lending your expertise to Trade Finance Talks. And thank you, everyone, for listening.
Thank you so much, Charles.